Hey, welcome back to the Seven Figure Music School podcast. I'm Daniel. This is Nate. We're joined today by a guest, returning guest, Jeff, who is of Ensemble Schools. You might remember from past episodes, Ensemble Schools is a group of schools across the U.S. That Jeff and his team have bought and are managing. And we were talking with him before we hit record today. Jeff holds a really unique perspective. He's bought a lot of music schools over the last 5 years, and with that experience comes a lot of knowledge and wisdom that I think can be useful to individual school owners who really, in most cases, only have the perspective of starting or buying or running one school. And so we like to have Jeff back on, especially for today's topic. Now, last week, we talked about a really interesting topic, which was, why would you sell your school? We're going to do a series of episodes here that have to do with the idea of selling your school or making your school a saleable, a valuable asset. And that kind of leads us to today's episode that we're going to talk about the idea of how do you actually place value on your school, whether or not you want to sell or keep your school, keep it as an asset. It's helpful to understand these topics so you can understand the value of the thing that you own, and in understanding that, understand how to increase that value. There's a lot of reasons you might want to increase the value of the asset you own other than just for selling it. So Jeff is a great person to have that conversation with, because a big part of buying a school is understanding the value of that asset. So welcome back, Jeff. I'm really excited that you're here.
Thanks. This is my personal specialty, so I'm glad to be here talking about it.
Yeah, I certainly wouldn't want to be talking out the side of my mouth about this topic. And the other thing too, and I'm gonna kind of pass the mic over to Nate here, is that this became a topic of real interest for Nate a few years ago, as he was considering some things about his school and just wanting to educate himself as a school owner. Nate, maybe we get the episode kicked off here with you talking a little bit about that. I certainly don't want to steal your thunder.
Yeah, totally. Well, I mean, Jeff, you and I met because at one point you approached, my partner and I around the opportunity, and we just began a conversation. And I had been had a couple of different friends that had sold their business in the past, and I'd even taken a course at one point on exit strategies for your business. And anyways, I think that, you and I we've known each other a few years now, maybe going on in 3 years. And it's just, I've really, really enjoyed the relationship that we've developed, and we've talked about a whole host of topics, but you really sparked, honestly, what you guys are doing at Ensemble sparked like a whole new level of interest for me in just this idea of having someone invest, in a music school or purchase a music school. And then also just this idea of how, and this is one of the things I think we're going to dig into today, is that, and Daniel, you were touching on this, but like having somebody else interested in your school as a valuable asset actually is really an empowering opportunity for all school owners to think differently about their business.
Sure.
Yeah.
One of the most common responses. So we do make outreach to school owners all the time. It's a core part of our business. We're trying to introduce ourselves to the market, and you're right. That is how we got in touch, and I'm very grateful for that as well. But one of the most common responses we get to that was, "Wow, I didn't know that was something that someone would be interested in. I didn't know that there was somebody out there looking to buy schools, and I maybe didn't even know that I could sell my school, that after me, my school could continue to function and to serve my community." And so I think it's great that you guys are helping to spread the word, and I'm happy to be here helping to talk about what we do on our side.
Jeff, maybe we could just start with this really broad strokes for a second, because it can get pretty technical pretty quickly when you're trying to value an asset, right? And I think both Daniel and I are really hoping we don't lose our listeners by getting too wonky in the conversation. So, can you just talk just really broad strokes to start? Like, how easy is it to value a school? I mean, you're probably assessing schools every week. What are some of the just broad strokes things that you look for, and how easy or difficult is that process for you?
Sure. So first of all, no matter whether you're talking about a music school or you're talking about a massive company like Facebook or Google, valuation is 9 parts art and 1 part science. So there's math and there's a lot of analysis that can be done. But at the end of the day, a lot of the math that people are doing, and even if you hire a valuations expert and they give you a valuation report and it includes, a value out to dollars and cents, even, the reality is that the precision is not there. And even when you're talking about, multi-billion-dollar companies, and that's my background, Nate. I mean, I came from the large cap investing world. I worked at private equity firms. I worked at hedge funds. Even when you're talking about incredibly large, incredibly well-researched businesses, a lot of the math you're doing are really shorthand ways of expressing qualitative views about risk and about growth prospects and about the future, which is impossible to be precise about. So it's one of these areas where it looks really sophisticated and complex to the outside world, but in the business, we all know that we're all just sort of making it up as we go along.
Right.
However, that's not to say that there aren't really actionable and sort of, because look, I'll share with you how the sausage gets made, but the reality is it's less precise and it's less scientific than maybe you would hope when you're trying to put a value on your own business, because something that you've really poured decades of your life into building. You want someone to be able to say this is what it's worth with a high level of certainty, but that's just not true. And one of the, there are many reasons for that. One of which is it matters who, it's going to be worth different things to different people, right? It might be worth something different to you as the creator versus someone who's buying it, who wants to come in and fill that owner operator role, versus someone who wants to buy it as a passive financial investment, and kind of everywhere in between those milestones, right? So valuation is in some ways kind of in the eye of the beholder as well. And so there's a lot of factors that are gonna come into play. However, the best and most useful method we have for determining the value of a small business is the fact that small businesses are actually bought and sold in our community on a very regular basis, right? So music schools are bought and sold. Our neighbors in our retail centers and our neighboring small businesses in our communities are bought and sold with some regularity. And we can look at those transactions and get a sense for what the market price is for a business, and start to come up with some parameters that we can use that are going to inform some of those kind of shorthand, imprecise valuation methods that I was alluding to in my preamble. But generally speaking, a valuation for a small business involves two things. One of which is some determination of the earnings power of the business, right? How much cash flow it generates to its owner. And we can spend a ton of time on how to calculate that number. But in the abstract, we're trying to figure out what is the earnings power of the business. And there's going to be some multiplier that's used to take 1 year of earnings and turn it into the value of the business. And that multiple is the same way we value, we value Google and Facebook based on a multiple of their earnings as well. So that's the same sort of shorthand math that gets done. And a multiple is if you've ever heard of, more complex or more kind of more scientific sounding valuation approaches like a discounted cash flow or things like that, a multiple is a shorthand kind of inverse discounted cash flow. It's a way of getting to a back of the envelope DCF or discounted cash flow without setting up an Excel spreadsheet. And so we use multiples because they're fast and easy and intuitive, and, sort of hide some of the false precision of doing a 20-year forecast and, discounting it back at 5.67% interest or whatever, number would be calculated. So those are the two components that go into almost every valuation, whether it's a small cap business or a large capital business. You're going to have some measure of earnings power and some form of multiple, which is a shorthand way of doing a discount rate calculation.
Mm. Yeah, it's funny, Jeff, because we're like at BMF, I act as our very part-time CFO. Me plus Leah, our bookkeeper, who helps a bunch. And oftentimes when I'm in my team meeting, I have to sort of reframe the financials in a way that's just sort of, that anybody on the team feels like they can wrap their head around and can do something with. And so I feel like when we're talking here around multiples, we need to come up with like a simple example. I'll often be like, okay, so imagine we earn $10 at Brooklyn Music Factory in a year. It costs us $8.40 to earn that $10, which means we have an earning power of $1.60, right? Yeah. So I wonder if you can give us a super simple multiplier example, or maybe both. Say earning like cash to owner, like you said, your earning potential, and then also a multiplier. Maybe give us a real sort of simple example.
Sure. So, I mean, an average school, let's say it's doing $500,000 of revenue, gross revenue, $100,000 of earnings to the owner, right? 20% margin is an above average, but, not exceptional margin. Gives us some nice round numbers to work with. That business is going to sell for something like $275,000 to $350,000, right? So that you're going to see a multiple range of something in the high twos to low to mid threes. And I'm imagining that we're going to spend, some of the next 20 or 30 minutes talking about kind of how we get to both of those numbers, right? How we get to the 3 times multiplier and how we get to the $100,000 of cash flow. But that's basically the math is you've calculated some kind of SDE, seller's discretionary earnings, some kind of earnings power figure. In this case, it was $100,000. You're going to pick a range. You're going to pick a multiple range and sort of figure out where you fit within it. In this case, maybe we're picking 3 times as our multiplier. The sale price for the business is $300,000.
Yeah, I love that. And actually, Daniel, you and I were chatting before, and we were prepping for this app, and you were like, hey, what would be cool would be to do an analogy to real estate comps, right? And I think you're already talking about that, but it might be lost on our listeners. I don't know, Daniel, you want to pick up there? But because I think that's actually a really nice analogy just to wrap our head around how we even get to 3X or, understanding other small businesses and that they're even selling.
Yes. Yeah. I mean, I think for my part, even with what I've heard so far, a question is forming in my head that I didn't have in my head 15 minutes ago. And that is the bottom line is that I think this is kind of a black box for most school owners. And the idea of the 3X multiple, that's pretty common in investing and M&A and all that. I don't think most small business owners have that, especially in the music school industry, have that number in mind. And so I just think even knowing that number and being able to do some simple math, it's like, oh, that's what I could get for my school, which then leads me to the question, which is you gave a range there. I think the thing that would be interesting to explore along with some of the other ideas that were proffered here is what would cause someone to be on the low end of that multiple? Yeah. What would cause someone to be on the high end of that multiple? Because I think if a school owner knows that, oh, that's generally, if there were 10 different organizations out there like Ensemble, and they're all going to be generally in that range, it's what the market will pay. So how do I get the maximum value out of my school, this thing that I built? Yeah. I think that's, and I know that only hints at a number of questions, but I think that's where my mind goes. So as long as we can cover all that while we're here, Jeff, do you have something to say about that?
Yeah, so absolutely. So valuation multiples depend on a variety of factors, and I'll list them in kind of rough order of importance. So by far, the most important component for choosing a valuation range is the size of the business. Because businesses exist on a spectrum from jobs, loosely disguised as businesses, to shares of public companies that you and I can buy in our retirement accounts that we don't Mark Zuckerberg needs no help from the three of us, unfortunately, in running Facebook, right? So that's a financial asset, right, on the other end of the spectrum. And the presumption is that as a business grows, it gets closer to being a financial asset because it has more ability to take care of, it has more resources to take care of its needs, vis-a-vis ownership. So if you have a business that's doing 50 million in revenue, the presumption is that even if you're the CEO of that business as the owner, you're going to have a whole team and some executives and some people helping you. And so that's actually closer to being a financial asset than, a lemonade stand at the other end of the spectrum. And we as music school owners exist somewhere in between those poles. And so there's sort of a break point for small businesses around about $1 million of earnings. So if you're not gross revenue, but earning power, kind of take home, adjusted net income, around $1 million is where you get sort of the presumption that this is more of a business and less of a job. And you start to see valuations of more like 4 to 5, maybe even 6 times for a really high quality business. And we'll get into indicators of quality in my next couple of bullet points. But size of business is really important. So below $1 million, certainly below $500,000, which is going to cover 99% of schools that we've seen. That's where kind of 2.5 to 3.5 is sort of the range that you expect. As you get towards $1 million of seller discretionary earnings, you start to see valuations more like 4 to 6 times. And as you get into like 5 to 10 plus, you can see valuations in the range of like 6 to 10 or even more for really high quality businesses. Public companies like Google or Facebook might trade for a mid-teens multiple of their earnings power. Wow. So size of company, by far the most important factor. And even within the kind of small business range that I gave, 2.5 to 3.5, if you are a small school, less than $100,000 of earnings, you're going to be towards the lower end of that. And as you get towards several $100,000 of seller discretionary earnings, you're going to be towards the higher end of that range. And so by far the biggest factor is size of school. Additional factors that matter but are much less important. So they're not going to determine, which range you fall into, but rather where you fall within those smaller ranges I gave based on company size, are going to be growth trajectory, both evidence of historical growth and prospects for future growth. Businesses that have the probability of earning more in the future are more valuable than businesses that are unlikely to earn more in the future than they do today. So growth prospects and growth track record is the next most important factor. Business quality in terms of business model. So all music schools have a relatively high quality business model because we have recurring revenue, kind of sticky customers that are with us for a long time. The revenue, we don't wake up every morning like a retail store does and have to win its customers from scratch every day. We have a base of students that are enrolled. And so the business is more, the revenue is more recurring, more repeatable, safer, less risky than other types of small businesses. And this kind of goes back to, is this a job or is this a financial asset? But, really strong systems and processes that don't involve the owner are going to place a business higher up on that valuation scale because it's more transferable. It's more clear that the business can function without the owner because there's really strong processes and documentation and team involved that can actually operate the business, irrespective of ownership. So I think those are some of the qualitative factors we would point to. Size is the most important one and the one that takes the longest to change. And the other ones sort of, growth trajectory, business model kind of quality, which is largely fixed. Although, if you're a school that is still charging by the semester or something like that, that is a factor where monthly recurring billing is more attractive from a valuation perspective than billing by the semester where, your students will just sort of turn over on January 1st unless they re-enroll. And then sort of showing evidence that you are not, you, the owner, are not critical to the day-to-day functioning of the business. are some of the smaller factors that will determine where you fall in that range.
You said evidence. I like that word. What evidence would you look for that they're not involved in the day-to-day?
Like, hey, I'm talking to you from Florida, and my school's in Ohio, and
Totally.
my phone's not ringing every 5 minutes, because I've been out to lunch with business owners whose phone rang 3 times during lunch, and like that's evidence to the contrary, right?
Yeah,
that's okay. That last addition, I'm out to lunch, and you notice how often they're interrupted, is a fascinating anecdotal measurement. I want to dig in if we can, because this is super. I think that our listeners are going to benefit right out of the gate with this notion that growth and size are actually going to be one of the biggest predictors for them as to whether or not they have an asset that's valuable to sell in the future. And so this totally, it hooks into that bucket number 1 of business, where it's like, how are your marketing and sales operating? But it's also gets into the bucket number 3 around inventory and whether or not they're aspiring to have the number of studios and the number of teachers necessary to even see growth or scale that you're talking about. So to keep it hyper real, Jeff, for our listeners, can you give us ranges, like in terms of number of students, number of classrooms, number of teachers or employees that schools have that have reached that size where they could potentially be kicking off 300,000-400,000 in net each year? Can you give us some aspirational goals for our listeners for those that want to develop this?
Sure. And I mean, not to self-reference here, but I would send people back to the podcast we did about our 7-figure music schools, right? So because we had a past episode about the fact that Ensemble owns several individual 7-figure music schools, and we talked about what those are and what they look like, and the fact that there are structural factors, particularly from an inventory perspective, that determine whether that's possible or not. Our biggest single location has 20 studio rooms and 1,100 students, and grosses about $2 million a year. That's our largest single location, and I think an average location for us, 9 or 10 studio rooms, 400 to 500 students a week, private lesson students, revenue in the $700,000-800,000 range. That's kind of, I would say that's pretty typical for us. But I mean, there's a lot of math that you can do for yourself in terms of how many studio rooms do I have, how many prime hours a week do I have to offer, right? Because that's different by market depending on when schools get out and whether parents in your area will sign up for 8 o'clock lessons or not, because we have some where they will and some where they won't. But right. So I think people can get there, and we spent, a good amount of time talking about it. But I think today at Ensemble, we generally don't look at schools that are doing less than $500,000 of gross revenue, unless they're really close to something we already own and there's some clear kind of scale benefit. Which is not to say that they're not saleable to somebody. It's just not the right fit for us. There might be, many other great buyers out there for that type of smaller business, but size is an important factor for us and definitely for valuation generally.
Love it. So we're talking about schools that are already seeing about 200 students a week to 400 or 500 students a week. That's the range. And just to clarify around your prime time versus off peak, basically you're saying like it's not that 9 or 10 classrooms are essential. It's just that you need to know your market because you might be able to see 400 students with 5 classrooms based on your demographics. So there's a little bit of math that's happening in there. Let's go for a second to business quality, because you and I talked in a previous episode about
episode 45.
Ep 45, dig
yep.
it. Thank you. Thank you for that, Daniel. We talked about the just really the number one concern for any school owner, which is retention, right? Like, how long are you retaining students? And you said just a moment ago, Jeff, you're like, customers are sticky. It's very different than a retail business. I loved how you framed that because I'd never really thought about the fact that I had to win their business every day at my shoe store, but at a music school, they're coming back every week. Do you have any version of metrics that you look for around retention for schools that you may buy?
I mean, I would love to be able to analyze that, but most of the prospects we're looking at are not keeping good enough data for us to be able to analyze that.
Oh, dig it.
Well, you got to tell us then what would be your ideal, because if someone's listening right now and they're like, oh my word, I own a school that does $500,000 and I want to retire in 5 years, like maybe I should call Jeff. What would you want to see from them?
Yeah, I mean, look, this is an interesting topic of conversation because I think one of the back to evidence for a second, if selling a business is something that's important to you in the future, considering what your business looks like to an outside observer is really important, right? And this is more about financial statements and financial fluency than other parts of the business. But like, even if you're just trying to partner with a bank and get a loan for, the last episode I listened to you guys doing was talking about Nate's build out. That's the last one that's been released as of the date that we're talking right now. If you just want to get a loan from the bank to do some construction on your building, like, you're going to have to present your business to them via financial statements. And so understanding what it looks like to an outside observer and being able to show evidence of the earnings power of the business, notwithstanding whatever personal expenses you may be running through there, which, of course people do and we see all the time. And we can talk more about that when we get to the calculating the earnings power and sort of talking about that in more detail. But evidence is, you want to be able to show your business from a financial perspective to an outside observer and have it communicate what you want to show about your business. And so being able to track and demonstrate, in some ways it's funny because although these are valuable things to be able to show in terms of selling your business, they're so much more useful in terms of running your business, right? So like, we shouldn't start tracking retention just so we can sell the business. We should track retention so we can run it today. And, because again, size, growth, profitability, these are going to be the larger components of valuation. And, we should manage for that reason, not because tracking retention will show what we're looking for. But look, I think if you have a school and you have, kind of 95 to 97% monthly retention. So from month to month, you're sort of churning 3 to 5% of your students. I think that's pretty typical. I think if it's higher than that, there are reasons for it, right? Like, I just serve a bunch of young kids and some of them cycle in and out. And like, there may be structural reasons for that, but retention is an input to the question of, what return am I getting on my marketing spend, which is another episode that we did and we talked more about that.
Yes.
But anyway, it's not something that's a common part of our acquisition analysis. And the reason is not because we wouldn't want to do it, but because most of the sellers we talk to are not tracking that information for themselves.
I think it's just helpful because I was wondering on behalf of the audience, the way in which you would think of measuring retention, because there are different ways of measuring retention. There are softwares out there that when you first enter the student inside that CRM, it will track how long until you mark them gone. And so if they're using that CRM, they might say, oh, this student stayed 25 months. And then as they look across the entire CRM over the last 5 years, they can get an average. But you're saying, oh, no, the way that I would think about this would just be a percentage of turnover across your entire student body monthly. There's nothing wrong with measuring it in different ways, but I was just curious specifically the way that was most meaningful to you. And you certainly answered that really well.
We track our own retention is that we track churn monthly, and then we look over a 12-month period and say, okay, over the last 12 months, we churned, 55% of our students, which means that our average life is 20% or 20 months, right? Across our business. And that's how we do it for ourselves. I think there are many valid ways of doing it.
Yeah. I do the same, Jeff, at BMF, where we just do month to month. I look at, we have 400 students. how many do we lose this month? And we report that as a team every month. And yeah, our goal is always to be between 2 and 4%. When we're 4%, that's when I get nervous.
Yeah.
That's a quality issue. That's a training issue. That could be systemic, or it could just be a single teacher or class we're doing. But we also do it annually.
Yeah.
Sorry,
well, I think no. I think from month to month that makes sense. I think that that's not probably realistic around the big kind of churn points in the year, right? Like December, May, or June.
That's what I was going to say. We do it. We then measure season to season. So we measure from spring to fall, and we always measure that number, and we know our historicals. And that's where it can get actually a little bit tricky for listeners, where they're like, well, wait a minute. I mean, people always stop in the summer, or how do I measure that? And what I hear you saying, and at least what BMF does, is we look at those big marks and we say, okay, well, what's the historical average there? From spring to fall, what percentage of those 400 families have committed to the fall? And it's not 96% like it would be month to month during the year. Yeah, it's closer. And just to be transparent for what we do at the factory, it's closer to like we're aiming for 90% in our private lesson program, and we're aiming for 70% in our group class program. So that's the clear metric we're aiming for anyone who's just looking for that. But I feel like, Jeff, I want to ask one other question, just following up. When you got back down to the idea, is this a solopreneur venture, or is this a business entity that we're building, right? So that's how I hear you say, like, is it a hobby? Like, for example, if you got a solo studio, you're teaching out of your living room, you got 40 students, that's that's closer to the lemonade stand, and that's not diminishing it at all, but that's could be called a lifestyle business in that regard, right?
Yep.
Versus you've got 9 studios and 15 teachers, et cetera. And I feel like you made a comment in passing, which is when we asked around retention, though, that gets to this, which is that many people aren't tracking the data, but I'm guessing, and you and I have had many, many conversations over the years, so I kind of already know the answer, but when you've come across a school that has systems in place to measure these things consistently, that must actually increase the value, or at least interest, in your mind.
Sure. Yeah, no, I mean, any evidence of thoughtful, systems-based business leadership look, unfortunately, it's a differentiator in our industry, right? It is uncommon to encounter that. And I think, that's probably not as true of fans of this podcast or clients of Grow or, other things like that. But among the industry generally, that's unfortunately uncommon.
Why do you think that is? I'm just curious. I know we're on a valuation topic, but honestly, Jeff, I'd love your opinion on this.
It's because the most common pathway that I've encountered for starting a music school is successful private teacher. Too many students on the waiting list. I'm going to hire a friend or two to teach my waiting list. Oh, now I have this small business that I never really planned for. I didn't come up through business. I came up through music and performing and teaching. And so I'm going to figure this all out from the beginning. And people are doing, first of all, a great job for their students. Even businesses like that might be a complete mess behind the scenes are delivering outstanding experiences for students in the classroom. And so it's just not a priority, right? The experience is even good enough to attract, word of mouth, marketing from parents and families. It's enough to attract a business. It's enough to make a living. And so there isn't a drive among studio owners with that history to take the business to the next level. And in cases where there is, it's hard for them to find resources like this podcast, like Grow, like other coaching programs. It's pretty uncommon for folks in our industry to kind of aspire to the executive MBA, even informally, of trying to become a better business operator, mid-career, like it is in other industries.
Yeah, it's interesting because I can vividly remember in 2014 or 15, we were like 5 years into the factory when I wrote my first like $20,000 check to a training program, a leadership training program. And I just thought to myself, Jeff, I was like, man, this is more than I paid for a year of college tuition back in 1990. I was like, this is, but that's that thing you're talking about. Like that's that mindset shift where all of a sudden mid-career, you're like, hey, actually, I'm interested enough to invest in this.
Yeah.
Daniel, you had something on your. Yeah, and this is totally free. Yep.
Yeah. I just wanted to make an observation that two of the fastest growing schools that I've encountered in the past year, both of them came from a corporate background where they had formal training and experience in the corporate world. One of those has been a 2-time guest in the podcast, Brian King.
I really enjoyed he was in episode.
Yeah. He's super fun to.
Yeah, he had, I think, almost 10 years background in corporate marketing. And so there is this sense that if you can bring both skill stacks together, that artistry, that ability to teach, and then bring a measure of business acumen, that's kind of the perfect combination. But what's interesting, and these episodes are already in the bag, but they haven't aired yet. But there's another fella who has no music background, and he's built or bought 11 schools, but with no music background, and it's just interesting. Obviously, his wife is his partner, and they started one school, and she was the head teacher. But those episodes are going to be coming out here pretty soon. Anyway, point being that I think investing in that way in oneself, as Jeff said earlier, is just such a good point. Yeah, it could be helpful towards selling something later, but there will be ongoing daily benefit now for taking some of the emotion out of the day-to-day operation of a school and just running it as a well-oiled systems-based machine.
Yeah.
And I'll point back to episodes 46 and 48 where we talk about systems and depth. Go ahead.
Yeah. Jeff, can we go up to your second bullet there on growth trajectory, which is one of my other fascinations. And so you talked about historical precedent, and you said you want to see in the business that they've shown that they can grow consistently year over year in some fashion. Maybe I'm actually putting words in your mouth. Maybe they don't need to grow consistently year over year. Maybe they just need to show that at some point they grew. Can you talk first about looking back on a business's growth and just what does that even look? What are you even looking for?
Yeah, I think the trajectory of a business can tell you lots of things, right? So from time to time, we talk to school owners who say, my best year was 2015. And since then, there's been challenges with my market. There's been challenges with competition. There's been challenges with, something that happened inside my studio or in my life, right? Something happened in my life and I wasn't able to run my business the way that I was, back then. But knowing that the business used to be bigger tells us two things. One, it has capacity for that. And two, there's some challenge that's present and that we need to be aware of.
Right.
If a school, conversely, if a school, is showing just sort of consistent growth year over year, there are more green flags, right? It's sort of, hey, this looks like, there's some things are going right here. There's a good fit with the community. There are positive indicators that product market fit is there and that the reputation, is good within the community. And then in between those extremes where you have a business that has shown decline and a business that has shown growth, there might just be like, hey, we're full, like, we're sold out,
capacity. Yeah.
And so we're at this plateau and we have a question about how we're going to grow past this. Or maybe we're not full, but we're still not growing, which is sort of, maybe we've saturated the market. Maybe there's some other challenge. Maybe we can't find enough teachers. Like there's some reason, but like the trajectory of the business is going to tell you what qualitative questions to ask about, kind of what's actually going on under the surface, right? So the declining business has a very different set of questions than the growing business has a different set of questions than the kind of stable, steady, but, why is it not growing business? And so that sort of frames the conversation we're having with sellers. And we're just trying to learn about the community that they've built from the outside.
If we were to take a hypothetical and go back to that 2015 was our best year, and now it's 2022 or whatever you're looking at it 7 years later, what would a follow-up question be? What would one or two or three be to help sort of unpack that puzzle for yourself so that you could trust the numbers you're looking at?
Yeah. Well, fortunately, there'll be a more recent history, right? So that, if it's just consistent decline, that tells a very different story than, we had a natural disaster and, we had to relocate, rebuild, or the population in this area was affected. The question is basically, what happened, right? Like what was different in 2015 versus in 2016, and why is that not fixed as of 2023? And those are kind of the follow-up questions. And then what you're trying to unpack there is all of this is driven towards having an understanding as an acquirer of what the future prospects for the business are, and you're trying to use the past to inform the future, and also ask qualitative questions about the future to understand, hey, what changes do you see happening in your school, in your area? Someone can tell us, oh, I'm in a really prosperous, really up and coming area, lots of great families moving in, but the data may show something different. And so it's important to hear both of those things, but to trust the numbers in terms of what to be asking about.
I just a couple more questions on valuation. I know I want to get to I do want to spend like a couple minutes on just the numbers. You gave some really interesting net income numbers earlier, but I had this question that came up. I had a friend who I met with through another business owner who had just sold their marketing agency, and she's like, you got to talk to this friend of mine. And the first thing he said to me, Jeff, was, he's like, Nate, the first thing you need to understand is business owners that want to sell usually overvalue their company in their mind. It's usually, they think it's worth more than it actually is. So I have a two-part question for you, Jeff. The first is, for those that are ready to sell and come to the table with a number, is that generally true in your experience that owners are overvaluing their asset?
So there's an interesting bit of behavioral psychology in play here, right? So if I put like a junky like coffee mug on the table that said if I put just a regular old trinket coffee mug on the table, branded as 7FMS, and said, Nate, this coffee mug's $5. You'd be like, no, I don't want it. I don't need a coffee mug. I have a BMF coffee mug, whatever. But if I gave it to you and said, this is yours, Nate, and I offered you $5 for it, you wouldn't sell it to me for $5.
I wouldn't sell it, right? Totally.
Right? So we can consistently demonstrate that. It's called the endowment effect, right? So what we have determines our valuation of things based on whether they belong to us or whether they don't. So this is a repeatable fact about human beings, and one which we should just not fight. But yes, your business will be more valuable to you than someone else's business under the same circumstances. Or if a year from now we switch seats and you bought your business back from me, you would value it less than when you were the owner. So the endowment effect is real and is present. But the other factor is just, one, valuation is imprecise, and two, people may have a valuation in mind that is not driven by what's my business worth, but by what do I need from the business to be willing to walk away from it. And that's a fundamentally different question that we encounter all the time, right? Yes. So someone might not be saying, hey, I need X to sell, sorry, let me walk that back. Someone may not be saying, I think my business is worth X. They might be saying, I need X to walk away from it. And those are not the same thing, right? So they don't actually know what their business is worth in most cases, but they know what they need to walk away from it. And those things might be wildly divorced from what the business is actually worth based on kind of market factors. And so there's an education process that comes into play where it's like, look, it's, I can tell you what the business is worth, and then it's up to you to decide whether that's something you can live with. Because, generally speaking, we don't try to separate people from their businesses with money. We try to partner with them at a moment in time where they're actually looking to do something else with their time and with their life. And they want a fair price for their business, but they've already made the decision to walk away. We're not making offers that are so fantastic as to people say, I can't possibly turn this down, and, whatever.
Right.
So, but there's often kind of a component of, this is what I would need to walk away, as opposed to this is what I think it's worth, that drives most of that disconnect on valuation.
Yeah. When actually the previous episode, Daniel and I talked through why the motivation to grow your business and exit strategy. And this is one of them, right? Like, you need to understand what value you need to get out of it if you're actually going to sell it to even make it worth growing, right? What's the purpose there? So then it was a 2-part question then on that, which is, if there's an area of the business, and if you want to go buckets of business, you can, or if you just whatever comes to mind, there's an area of business that an owner is likely to specifically overvalue, what would that be? So, for example, we think our marketing funnel's priceless. I'm not saying that.
Yeah,
about
no, I know what you mean. I mean, the most common mistake is, I have all this gear, it should be valued separately from the business.
Right.
And that's incorrect, because the gear is part of value, is part of generating the cash flow. So the example I always give is the taxi cab business, right? So if you have a taxi cab, a vehicle, and you have a taxi cab business, you can't sell them separately to different people. The taxi cab itself is an integral part of generating the cash flow for the taxi business. And oftentimes people say, I have all these assets in my studio, I have these pianos, I have all this gear. And it's like, okay, well, if you have a Steinway B in the back, maybe we could swap it out for a Yamaha, and maybe you can keep that extra value. Maybe there is real excess value in that asset. But fundamentally, the fact that you have gear in your studio is required to its functioning as a studio and the cash flow. So the most frequently made mistake is sort of wanting to value the business and its assets separately and add those together to get a larger number for valuation. The cash flow valuation includes, like the one that we were doing earlier, that where you take the cash flow times a multiple, that valuation includes the assets because they're needed to generate the cash flow. But in terms of, it's mostly the emotional connections that are the ones that trigger the kind of, the emotional connection to the business, and the fact that it's just because we see the same people every day, and we don't, face the general public kind of walking and browsing through our shoe store. We have a deeper connection to the human beings that are part of it. And we as Ensemble try really hard to make that part of our pitch to owners, that we're actually going to do a really good job of taking care of those people, and that you're going to see your general manager thrive in a new role, and you're going to see your students, really well supported. And that's part of our pitch, is like, we're not just going to buy we know that for an owner, it's not just about the check they're receiving, but rather about placing their business in a safe pair of hands. And so that's part of our pitch and part of our offering. But I don't think no one's like, hey, I think my website's worth, $100,000 because, but I think it's assets generally, and then just the emotional connection and reluctance to walk away from something that someone's invested a lot of time into are kind of most of those factors. And then just lack of knowledge, right? Like, just lack of time spent thinking about what small businesses generally, let alone your own small business, are worth, lead to disconnects in valuation.
I think a takeaway from all of that is that obviously human beings are emotional creatures, and there's no way to truly separate the emotion. But what I often encounter in coaching is people who do an awful lot of hand-wringing and make emotional decisions, or they obsess over tiny decisions. Whereas if you took more of a cold, calculated view of it, again, maybe you're not intending to sell, but if you would think like someone who is, you wouldn't think, oh man, should I use purple or fuchsia on the website? Like, these are the kinds of questions I sometimes like encounter where like people are waiting months to make a decision on something, when in reality it's just like, yeah, just make a website, make it like 3 pages, 5 menu items, make your offer really, really clear, be done with it. Don't think about it. And that will do, it will fulfill the function that it's there for. Again, not to say that not putting a lot of detail into something isn't important, but I'm in a unique perspective, as Jeff has a very unique perspective. I have a unique perspective too, because I encounter these kinds of conversations all the time where someone's just dragging out a decision, and I'd say use a little less emotion when you're thinking about this, because investing that emotion into it probably isn't worth it. It's not going to make the business more valuable or run better than it would if you just made a decision. Oh yeah, blue's fine.
Yeah.
Anyway,
I think overall care is evidence, that it shows up in lots of places, but it can't come at the expense of, action at some point, right?
I feel like this brings us full circle to where we started, which is just, as you said, the number one piece to valuation, Jeff, is size. And then what comes with that, of course, is its earning power, net income, et cetera. I was going to ask you just a couple of questions, and then the third one was just going to be open-ended of any other additions you wanted to share there on valuation or this topic specifically. But again, going back to target range, you said like 20%, while it's unusual for a net. Let's just use that for our hypothetical. Can you give us a range if for our listeners, if they're like, I'm in a growth stage of my business, I'm trying to get more financially fluent, I want to set myself up for long-term success and potentially a high valuation when I sell. What's that sort of net? What's the percentage range that you think should be a target for someone growing, like, say, over the next 3 years?
It is structural to some extent, right? Your ceiling on your margin is going to depend in some ways on where you're located, both because your 2 biggest costs are your people by a lot, and then your building, right? That's that's going to be 50 to 80% of your total costs for your business, and those are more or less expensive relative to what you're able to charge in tuition, depending on where you are, especially for rent, right? Because in our experience, suburban market tuition, it might be 80% of city center, but suburban market rent might be 50% of city center rent, right? So like there's big differences in terms of the margin that you're able to generate based on where you are. But I think 15% is healthy, 20% is good, 25% is great, in terms of net margin for a music school, for a brick and mortar music school. There are some components that are trade-offs in there, like if you're a Piano Express customer and you're able to, really drive a bunch of revenue through there, that might be great. And group classes generally have higher margins, but at the expense of faster turnover and lower customer lifetime value. And so it's sort of a fundamental, it's different. There's trade-offs there in terms of margin versus retention, and kind of the need for other types of spend, like marketing spend, is higher generally to fill a group lesson program than a private lesson program. So those things all trade off, but I think 15% is a healthy margin for a small business. 20% is good and well above average, and 25% is exceptional.
Do you see that as companies scale, so they go from a $600,000-$700,000 gross business to a $1.5 million gross business? Do you see those margins change? Is there a trend that's predictable?
Yeah, so a financial fluency item that I really like to guide people to is thinking about gross margins in addition to thinking about net margins. So your gross margin for a business is your revenue minus your variable costs. So that tells you basically it's a shorthand way of determining for the next dollar I make. If I go from making $100 to $101, even if I'm only keeping 10 of the first $100, how much of the next dollar am I keeping? Right. And for a music school, that's generally going to be, 55%, right? It's going to be a big number relative to those numbers I just quoted. So basically what's happening is if you're starting from a 15% net margin, but you're adding incremental dollars at a 50+% incremental margin using those. So $100, our school makes $100 and has $100 of revenue, $15 of profit today, right? If we add $10, so we go from $100 of revenue to 110, we've grown by 10%, we've grown revenue by 10%, but our incremental margin is 50%. So we kept 5 of those incremental $10, which is not uncommon. That's realistic. Our net just went from 15 to 20. So it grew by 33%, right? So revenue grew by 10, net grew by 33%. That's called operating leverage. And that's evidence of the larger business now has an 18% margin instead of a 15% margin, right? And so margins definitely scale with business size, and it's because some of the costs in your business are fixed, rent, administration, that kind of thing. And so margins definitely improve as you grow, which is another reason to pursue growth, right? Not just growth for growth's sake or sort of capitalist ethos, but the fact that your business becomes more profitable dollar for dollar as you scale past a certain point.
Yeah, that's a great addition in terms of that, and I appreciate the answer. And so one of the flips in my mind always, Jeff, just around the fluency piece is the fixed parts. When we're talking a place like where we are in Brooklyn, the national average for a music school as a percentage of rent is somewhere in the 4 to 6% of their gross revenue. In like sort of after school arts programs in the research I've done. And yet at BMF, historically, we were at 11 to 12% of our average went to rent. And so that was one of our goals, was to push that down in the new space. And we've been successful in pushing it down. And to your point, as BMF grows to its capacity, that rent number will just, as a percentage, will get smaller and smaller.
Yeah.
Right.
I've heard you say that before. I think it might be discouraging to your listeners. I don't think we have any schools where we have a 5% rent as a percentage of revenue. Most of ours would be 10 to 12.
Really?
Yeah. 15. And
is your average 10?
Yeah. I consider rent as a percentage of revenue at 20% to be unhealthy, unsustainable. And evidence of needing either a different space or to grow the business in its existing space. But I think 10 to 12% is very healthy, and we have some at 15% that do just fine if there's other structural things that are fine with this. But I don't think that number is. Although I know I understand you've sourced it from a reputable third party source. I think there's other things that are clouding that number, because a brick and mortar music school we own 44 of them. We don't have any that are in that range.
Yeah, I feel like your data point is more valuable, because this one's coming from all arts, education programs that could include dance schools, after school art schools, gymnastics, whatever it is. Maybe not athletics, but cool. Okay, so maybe a final question on this valuation piece, which is just. I guess it gets back to this sort of the owner, and you said the owner is ready. You're looking for schools where the owner's already made that mindset shift, where she's saying, you know what, I'm ready to move on to whatever the next opportunity is. Can you tell us examples or stories where the founder stays on in a successful way with the company, and then maybe also share a story? And I'm asking the question specifically from a valuation piece. So in other words, let's say the founder was like, I'm ready to sell, and I'm ready to continue to serve this business for, say, another 3 years. And so there might be an earning opportunity there for them that they're not really thinking about when they're listening to this episode. Any thoughts come to mind there, or stories you want to share?
Yeah, so we've had a variety of relationships with sellers. We probably have 5 folks that have stayed on as master teachers, and 3 that are actively operating their business for us. And in those cases, it's really important to separate the transaction into 2 things. One, they're selling us the business, and that valuation is not impacted by their go-forward involvement. And then 2, we're rehiring them as general manager on arm's length terms, right? So there's a separate negotiation around what that looks like. I think for those people, their motivation was to sort of downsize the scope of their involvement, to take out some of the what I like to jokingly refer to as the 10 p.m. tasks, the stuff you do after the studio is closed and people have gone home for the day, right? So Ensemble is doing, payroll, finance, tax, compliance, HR, a lot of the heavy lifting on marketing. So we're providing a lot of those services. And so the school owners that sold to us and stayed on to run them basically get to just sort of lead their community. They get to do the fun parts of their job. And then they've also taken this step towards retirement, right? So they've already sold the business. Now when it's time to retire, they just need to quit their job, as opposed to having to figure out how to sell the business at the moment where they're also looking to retire. So we have those relationships. We have folks that stayed on as master teachers. They keep their private students. We pay them a premium rate for teaching. People probably still think they own the business, but they don't have that administrative responsibility anymore. And then lots of folks that left, common reasons for selling, the best, the most fun example I have is that we had a guy who sold us a business so he could go be a missionary in Kenya. So he felt called to that, and that's a cool story. But much more common, retirement, relocation, family, whether it's kids or grandkids, sort of changes in family structure that are making people want to spend their time in different ways. Other business interests, so other businesses that they might be involved with that are offering them better. They want to invest their time differently, basically. So we've seen all of those.
Yeah.
And it's every deal is different. And I come back to what I said 20 minutes ago. We're trying to create win-win solutions for owners that are, have come to a moment where they realize they want to do something different with their time, and they want to entrust their business to somebody that's going to take care of it like they would want to. So yeah, we won't provide that motivation, but we'll provide a really safe pair of hands and a fair valuation on the back end of that.
Yeah, I love it. I bet you a lot of our listeners are thinking whether or not, like, as you said, Daniel, to open the app is just, I may not be there right now, but this episode's helping me imagine like a different version of 10 years from now, or 5 years from now, or 15 years from now. Jeff, any final thoughts on your part around valuation or just?
Yeah. Well, so we've spent, I told you that valuation is a multiplication of A times B, right? Like earnings power times multiple. We spent 40 minutes unpacking what affects a multiple. We didn't talk at all about how to calculate the earnings power of the business. And I feel like I'd be doing your listeners a disservice.
Let's go there.
So
I would love it.
Yeah, so I'll try to do this in just a couple minutes, but maybe you can go back and cut something else I said that was less relevant to make room for this in your episode. But look, so in the small business world, we refer to this as seller's discretionary earnings, and what that number is sort of appropriately hinted at in that title, which is sort of all the cash flow that comes to the owner of the business, regardless of what they spent it on. If it was in their discretion to spend, it's earnings power for the business, right? So the most common example is people, running their personal automobile through the business, or sort of, paying themselves home office rent, or things that we do for tax purposes. Right. Those are things that are generally above board. There are other things we see that are probably a little bit more questionable, like, from time to time, I go to Costco, I swipe the store card. Sometimes those groceries come to my house. Sometimes they go to my business. Who knows where it ends up, right? Like we see some of those things. But what we're looking for is, what is the earnings power of the business, to its owner before they decide how they're spending that, whether that's on salary for themselves or family members, whether that's on personal perquisites, whether it's on personal travel, any of that kind of stuff. And this is another area where evidence is really important, because you might be able to say to me, hey, I'm running XYZ personal things for my business. But if you can't demonstrate that to a reasonable level of satisfaction to an outsider, you can't get credit for it. And so this is another area of financial fluency, and another area of presenting your business to a third party from a financial perspective, where you need to be able to say, look, obviously, I run a music school that doesn't need a car, right? So my auto and my auto expenses are clearly, valid add backs. And here's home office rent that's going to go away. And here's a salary I was paying to my teenage kid to do a few things around the studio, but they're not needed in that capacity. Like those are really easily identifiable things. the one where it's like, hey, I have one Amazon account and sometimes I buy stuff for my house and sometimes I buy stuff for the school, that's going to be impossible to disentangle after the fact. And so, while it might be a strategy for reducing your tax burden in a way that is of questionable legality, but is also really muddying the waters as it relates to the value of your business on a go-forward basis. And, you never know when you're going to need to, build out a new school or something like that and actually have to demonstrate that to somebody. And it's often too late at that point to go back and, keep really clear and clean, books from for the business, and also making sure that it's separate and distinguishable from other business interests that you might have, right? So not running one set of books for, your music school business and your landscaping business, or for the, if you own your retail center and you lease to other businesses nearby, like not, keeping separate books for, each business unit is really important. In terms of being able to have someone come in and evaluate what that earnings power is or might be. So that's the number we're trying to get to. Generally speaking, what you do is you take out your tax return, you look at the net income figure, and then you start adding back the non-cash charges like depreciation and amortization that your accountant added to sort of comply with tax rules, but were not cash expenses of the business. You add back salary for you or family members that is in excess of your replacement cost, right? So there's, the business needs a manager. If you're currently that manager, that cost has to be accounted for. But if you're paying yourself 2x the market salary for that, well, then some portion of that could be added back to think about what the earnings power of the business is. And then any kind of, demonstrable, evidentiary, personal expenses that we can point to and say, this is not needed on a go-forward basis, those would all be sort of added back to get to that seller's discretionary earnings figure that we're then going to multiply by 2.5, 3.5, based on the range that we talked about over the previous 50 minutes to get to where we are.
That's super helpful. And it just reminds me, I feel like we have to double down on what we were saying earlier, which is getting organized here, Jeff, with your finances and being able to portray a clear picture is not only valuable around a future valuation and selling, but it's just really smart right now to actually know what your business is doing.
Sure.
And then, and I think also like just moving past the mindset of, like at some point you're going to ask for help, a bank or whatever, and you need to be able to present a clear story. Any final thoughts, additions on valuation? This was fascinating to me.
Yeah.
As always.
Well, I think mostly what we're doing is just pointing at, thinking about our businesses unemotionally in similar ways to how we would view our neighboring businesses in our communities, and realizing that they are bought and sold all the time. And we can look at them as really strong indicators of what our business is worth, notwithstanding the endowment effect, notwithstanding the fact that we love all these people that are part of these communities. But when it comes time to get down to it, this is commonly how a small business of any type, including a music school, gets valued.
So, Jeff, thanks for coming on the episode. A lot of knowledge bombs dropped here. Where can people find you on the internet? If someone wants to get in touch with you or learn more about Ensemble or the process you all go through in buying a school, or even reach out to you to talk about the possibility of that, what's the best way to get in touch?
Sure. Yeah, no, we can be found online at ensembleschools.com. We actually have a whole section of our website that's geared to school owners. We love to start building relationships with folks that own music schools, whether they're interested in selling today or selling in the future. We're always happy to have that conversation and get it started now, even if it's not actionable and for many years. And my personal contact information is just jeff@ensembleschools.com, JEFF at ensembleschools.com. So always happy to hear from school owners and looking forward to connecting.
Yeah. Thanks, Jeff. Until next time.
Thanks, Jeff.
Thanks
so much. All right.